All right, so are you ready to unlock some serious investing wisdom today?
Always ready for that.
Yeah, we're diving deep into Warren Buffett's world.
Okay.
And we're using the Snowball, his biography, as our guide.
Right.
It's one thing to be rich, but Buffett's not just about the billions, right?
It's the way he got there.
Yeah, what's fascinating is how he's consistently grown his wealth year after year, turning a relatively small starting point into a financial empire.
I mean, that's what's so impressive, right?
It really is.
It's not winning the lottery. It's not, inheriting a bunch of money.
Right.
It's that consistent growth.
And we're talking about an average of 20% per year.
Exactly.
I mean, that kind of sustained growth
That's right.
is what really sets those truly successful investors apart from everyone else.
I think another thing, too, that's so interesting about Buffett is that he just loves it,
Oh, yeah.
Like, even on his honeymoon, he was poring over financial reports.
No way.
So, I mean, talk about dedication.
Wow, that's incredible.
That's part of what makes him so successful.
I guess that level of dedication really is a key ingredient.
It is.
But, we're not just here to admire him from afar.
Yeah, that's right.
We're digging into the core principles that helped him get there so you can apply them too.
That's the goal.
So where do we even begin with all this wisdom?
Well, let's start with maybe the most crucial element of Buffett's success.
Okay.
The power of compounding.
All right, I'm intrigued.
Yeah.
So the Snowball uses this analogy about a manager who pays you earlier each day for the same amount of work.
Okay.
So you're essentially getting rewarded more for less effort over time.
Yes.
Explain that. How does that tie into investing?
So that analogy perfectly captures the magic of compound interest.
Okay.
Every dollar you invest early on is like a little worker that never sleeps.
I like that.
It keeps earning for you.
Right.
And then those earnings go on to earn even more. So that's that snowball effect in action.
Okay.
And that's what turns small sums into massive wealth.
Over the long haul.
Over the long haul.
And it's not just theory with Buffett, right?
No, not at all.
The book mentions how he was already putting this into practice.
Yes.
As a kid with his pinball machine business.
Right.
He understood the power of putting money to work early on.
Absolutely. He was a hustler from a very young age.
Yeah.
He was always looking for ways to make money.
Wow.
And he wasn't afraid to take risks.
So is that part of it? Like, is that part of compounding, taking those risks?
Well, it can be.
Okay.
Especially early on in your investing journey.
Okay.
Because you have more time to recover if things don't go your way.
That makes sense.
So you can afford to be a little bit more aggressive.
Okay.
And we actually see that in some of his bigger investment moves.
Like what? What kind of moves?
Like taking on more risk early on with his profit-sharing partnership.
That really accelerated his growth.
I see.
And then there's his move into insurance. Insurance. Which to me is pure genius.
Wait, insurance? How is insurance? I wouldn't normally associate insurance with massive wealth creation.
Right. Because you think of paying premiums.
Yeah, exactly.
And, hoping you never have to use it.
Right, exactly.
But think about how insurance works from the company's perspective.
Okay, yeah.
People pay their premiums up front.
Yeah.
Giving the insurance company this large pool of money.
Okay.
That can then be invested.
Okay.
Right.
Right.
And then those investments generate returns.
Right.
And those returns compound over time.
I'm starting to see it.
All before any claims have to be paid out.
So it's like having this constant influx of cash.
It is.
That's working for you.
Exactly.
While you wait to fulfill your end of the deal.
That's a great way to put it.
Clever? Clever.
So even if we're not all aiming to be billionaires, this principle of compounding,
it's essential for everyone,
It's about building that long-term wealth.
Exactly. It's not about getting rich quick.
Yeah.
It's about building that slow and steady snowball over time.
So every dollar saved and invested today is essentially a seed.
Yes.
That can grow into something much larger down the road.
Absolutely.
I like that. Time is definitely on your side when it comes to compounding.
It is.
Okay, so we've got the power of playing that long game.
Yes.
What else is in Buffett's playbook?
Well, another key takeaway is the importance of being skeptical of so-called new paradigms.
Okay.
Buffett actually has this great quote about them. He says, new paradigm, it's like new sex, there just isn't any such thing.
Right.
And, it's funny, but it's also true. Like, this skepticism is what kept him grounded.
Yeah.
Especially during times of market frenzy, like the dot-com bubble.
Oh, I remember that time.
Yeah.
Everyone thought they were going to get rich quick on internet stocks. It felt like a whole new world of investing had opened up.
It did. It felt like the rules didn't apply anymore.
Yeah.
But Buffett, he saw through the hype. He saw a disconnect between the hype and economic reality.
Okay.
He knew for these sky-high market valuations to be justified, something fundamental had to have changed. Were interest rates plummeting? Was the economy, magically booming?
Yeah.
In a way never seen before?
And the answer was a resounding no.
A resounding no.
But how do you stay grounded when everyone around you seems to be, drinking the Kool-Aid?
That's where Buffett's concept of the inner scorecard comes in.
And their scorecard.
Okay, so this is about having your own set of values and investment principles.
Right.
Like your own definition of success and not getting swept away by the crowd.
Right. Don't just follow the headlines.
Exactly. Do your own research.
Yeah.
Understand what you're investing in and make your decisions based on logic.
Right.
Not just on what everyone else is doing.
That's easier said than done, though, right?
Oh, it's much easier said than done.
Yeah.
But it's so important. Think about the Dow Jones Industrial Average between 1964 and 1981.
Okay.
It remained practically stagnant.
Really?
Even though the economy grew fivefold during that time.
Oh, wow.
Fivefold.
That's wild.
It was a classic example of people getting caught up in that speculative frenzy.
Right.
Ignoring those underlying fundamentals.
So Buffett's inner scorecard helped him avoid that trap.
Absolutely. He has a very strong sense of his own values.
Yeah.
And he doesn't let the market dictate his decisions.
So it's almost like he's saying, don't let that fear of missing out lead you to make bad decisions.
It's so easy to get caught up in that, especially, in today's world with social media.
Oh, yeah.
And everyone talking about what stocks are hot.
Absolutely.
It's more important than ever to have that inner scorecard, to know what you believe in.
To define your own success.
Exactly. The Snowball poses a great question about this.
Oh, really?
It says, would you rather be the world's greatest lover, but have everyone think you're the worst, or the world's worst lover with everyone thinking you're the best?
Ooh, that's a tough one.
Yeah, and it's a good thought experiment.
Yeah.
Because it highlights the importance of focusing on what truly matters to you. Not external validation, not what the market is dictating.
I like that.
But your own internal compass.
It's about knowing your own values and sticking to them.
Exactly.
Which actually ties in nicely with Buffett's next principle, right?
Let's hear it.
The one about staying within your circle of competence.
Absolutely. So Buffett, he avoids what the book calls the shoe button complex.
The shoe button complex, what's that?
So this is this tendency to think you're an expert on everything.
Right.
Just because you're good at one thing.
Oh, we all know someone like that, right?
We all know someone like that.
Yeah, for sure.
But Buffett, he stays in his lane.
Right.
He sticks to what he understands deeply.
Yeah.
Money and business. He even chose not to pursue writing.
Really?
Even though it was his grandfather's dream for him to become a writer.
Interesting. Probably a wise choice, though, right?
Probably a wise choice.
Considering his track record. So how does this stay in your lane thinking apply to investing?
Well, if you don't truly understand how a company makes money, you're speculating, not investing.
Right.
Buffett, he's notoriously wary of tech companies that he finds too complex. He sticks to businesses that he can wrap his head around.
So it's not just about picking stocks that sound exciting or trendy.
No, it's about understanding the underlying business.
Yeah.
It's about knowing what you're getting into.
But wouldn't that limit his potential returns?
Well, it might seem that way,
yeah.
But Buffett believes it's better to make a few great investments within your area of expertise than to spread yourself too thin and risk making uninformed decisions.
So less is more, focus on quality over quantity.
Exactly.
Okay, I like that.
And that actually brings us to another crucial principle, margin of safety.
Margin of safety, okay.
So this is essentially about building in a buffer to protect yourself from being wrong.
All right, break that down for me. How do you build a buffer into your investments?
Okay, so think of it like this. You're an engineer.
Okay.
You're building a bridge.
Okay.
You know, the heaviest truck that'll cross, it'll weigh 40 tons.
Mm-hmm.
Do you build a bridge that can handle exactly 40 tons?
No.
Or do you factor in some extra strength just in case?
Extra strength for sure. You don't want a bridge collapsing because you cut corners.
Exactly. And investing is very similar. We're bound to make mistakes, you know, miscalculate things, encounter unexpected events.
Right.
A margin of safety means buying a stock.
Okay.
At a price significantly lower than what you believe a company is truly worth.
So if you think a company's worth $50 a share,
right,
you don't buy it at $50.
You don't buy it at $50.
Wait for a dip, you buy it maybe at $40.
Exactly.
So even if you're off a bit,
you've got that cushion.
You're still in good shape.
You've got that cushion.
So, and Buffett, has he always had this approach?
Well, he's had different ways of applying this principle. Early on, he focused on finding those undervalued, often overlooked companies.
Okay.
What he called cigar butts.
Cigar butts? What's that?
So they might not be glamorous, but if you can buy them cheap enough, there's still a chance to squeeze out one last puff of profit.
I like that. It's not about chasing those hottest stocks. It's about finding value where others overlook it. But this isn't just for beginners, right? I mean, Buffett still uses this margin of safety thinking today.
Absolutely. That mindset is what kept him out of the dot-com bubble.
Right.
And other market frenzies.
Yeah.
He understands that patience and discipline are key to long-term success.
So it's better to miss out on some opportunities than to lose big on a miscalculation.
Exactly.
Safety first, then profit. I like that.
And this focus on safety and long-term value actually leads us to an interesting evolution in Buffett's philosophy.
Okay.
This shift from pure value investing to understanding long-term competitive advantage.
Okay.
And this is where the toll bridge analogy comes in.
A toll bridge. Okay. I'm picturing a bridge. Tell me more.
So imagine owning the only bridge across a river.
Okay.
You've got a captive audience, right?
Right.
People have to use your bridge to get to the other side. Mm-hmm. So you can keep raising the tolls, increasing your profits, essentially, because there's no competition.
Right.
And Buffett literally owned a bridge connecting Detroit and Windsor at one point.
He did?
He did.
Wow, I didn't know that. But how does this bridge analogy translate to investing?
It's about identifying businesses that have what he calls moats. Moats. So these are defenses against competition that allow them to maintain pricing power and profitability over the long haul.
So instead of a physical bridge, it's more like a metaphorical bridge.
Yes.
Representing that company's unique advantage.
Exactly.
In the market.
Yeah.
Okay, give me some real-world examples of these moats in action.
Sure. Think about a brand like Coca-Cola.
Okay, yeah.
Even if you invented a tastier soda, you'd need billions in advertising to compete with Coke's brand recognition.
Right. Brand loyalty is tough to beat. What else?
So you have network effects.
Network effects, okay.
So the more users a platform has, the more valuable it becomes.
Think social media platforms like Facebook?
Yeah.
A newcomer would have to overcome that massive user base, which is a huge barrier to entry.
It's like that saying, the rich get richer.
Exactly.
The more users you have, the more attractive you are to new users and so on.
And so on.
And what about, are there other types of moats?
Oh, absolutely. There's also stickiness.
Stickiness, okay.
This refers to switching costs.
Okay.
That keep customers loyal.
Okay.
Think about learning complex software like SAP. It's such a pain to switch to a competitor.
Right.
Even if their product's slightly better.
Yeah, you've already invested so much.
You've invested so much time.
Time and energy.
Yeah. Money sometimes into learning that system.
That makes sense. And then there are businesses with high setup costs like railroads. It's just not feasible.
It's just not feasible.
If someone to come along and build a competing rail line right next to an existing one.
Right.
Exactly. The cost is prohibitive.
The cost is way too high.
Right. So these toll bridge businesses, they might be pricier up front.
Okay.
But their long-term profit potential is huge.
Okay.
And that's what Buffett focuses on now.
Yeah.
He seeks those companies that can consistently generate returns for years, even decades to come.
And that goes back to that long-term game.
That's right.
Just like we were talking about with compounding.
It all ties together.
It all ties together. Okay, so far we've covered compounding.
Yep.
Skepticism, staying within your circle of competence, margin of safety. now toll bridge businesses.
It's a lot, but it's fascinating.
It's a lot to take in, but it's fascinating to see how it all connects.
It does.
What else can we learn from Buffett's approach?
Yeah, it really is a lot, but it all feeds into this larger picture.
Yeah.
We've talked about the analytical side of Buffett's approach, but there's another layer I think we haven't really touched on yet.
Okay.
The importance of temperament in investing.
Temperament.
So
it's not just about being good with numbers.
Right.
Understanding financial statements.
It's more than that.
There's more to it.
Oh, absolutely.
Okay.
Buffett stresses the need for emotional discipline.
Okay.
The ability to stay calm and rational when everyone else is losing their heads.
Right.
He often talks about being greedy when others are fearful.
Yeah.
And fearful when others are greedy.
That makes a lot of sense. It's easy to get caught up in the hype especially when the market is soaring.
Yeah.
Or panic when it's crashing.
Right.
But Buffett seems to be able to just detach himself from those emotional swings.
He does.
Yeah.
He recognizes that the market is often driven by emotion in the short term.
Yeah.
And those emotions can lead to some really irrational decisions.
Yeah, for sure.
And so his ability to step back and make those objective decisions based on his analysis rather than on fear or greed, that's a key part of his success.
So it's like that inner scorecard we were talking about earlier. You know?
It is.
Stay focused on your own goals.
Yeah.
Your own assessment of a company's value.
Exactly.
And don't let the market kind of dictate your emotions.
Don't let the market play you.
Right.
You play the market.
Be the one in control.
Yeah, exactly. And this also ties into another important principle.
Yeah.
Patience.
Okay.
Buffett is known for his long-term perspective.
Oh, yeah.
He's not looking for those quick flips.
Right.
He's looking for businesses he can hold for years.
Right.
Even decades.
Yeah, I remember reading that he once said his favorite holding period is forever.
Forever.
It shows a real belief in the power of compounding.
Yes.
Letting those investments just grow over time.
And if you believe in the underlying business, why would you sell it just because the market is having a temporary dip?
Unless you need the cash.
Right.
Something, right?
Exactly. The
point is, don't let short-term market fluctuations derail your long-term investment strategy.
Exactly. Patience allows your investments to compound. And it prevents you from making those rash decisions based on fear or FOMO.
Yeah, I like that.
Yeah, so we've got...
Okay, so we've covered compounding, skepticism, staying in your circle of competence, margin of safety, toll bridge businesses, emotional discipline.
Yes.
And now patience. It's amazing how all these principles kind of intertwine.
They do.
And reinforce each other.
They do.
Yeah. Is there anything we're missing here?
Well, there's one more aspect I think that we can't overlook.
Okay.
And that's integrity and ethical behavior.
Okay.
These are foundational to Buffett's approach.
Right. So he's not just about making money.
Right.
He's about doing it the right way.
Doing it the right way.
Yeah.
Yeah, and it seems to me that his reputation for honesty and fairness has played a big part in his success.
Yeah, for sure. People trust him.
They trust him.
They want to do business with him.
Absolutely.
And that goodwill is invaluable.
It really is.
So it's not just about the numbers, it's about character.
It's about character.
Values, building trust.
It's about who you are as a person.
Yeah, it seems like a recurring theme in Buffett's approach.
You're spot on. Buffett's principles are as much about who he is as a person as they are about investment strategies.
Right.
He's shown that you can be both successful and ethical. That you don't have to compromise your values to reach the top.
So if we were to distill all this wisdom into a few key takeaways.
Okay.
What would they be? What are the core principles that anyone can apply, regardless of how much money they have to invest?
Well, first and foremost, focus on the long term.
Okay.
Don't get caught up in trying to time the market.
Right.
Or chase those short-term gains.
Got it.
Second, invest in businesses you understand.
Right.
Stick to your circle of competence.
Right. Quality over quantity. Focus your energy where you have an edge.
That's it.
What else?
Third, look for companies with a durable competitive advantage.
Okay.
Those toll bridge businesses we talked about, they might be more expensive up front, but they offer that potential for sustained profitability over the long haul.
Okay.
And of course, don't forget margin of safety.
Yeah.
Always buy below what you think a company is worth.
Right.
That cushion can protect you from unexpected events or miscalculations.
That's fine.
And finally, remember that investing is as much about temperament as it is about analysis.
Right.
Stay disciplined, be patient, and don't let your emotions cloud your judgment.
It's a powerful combination.
It is.
Of smart strategies and the right mindset.
Absolutely.
It's not a get-rich-quick scheme.
It's not, no.
It's a blueprint
It's a plan.
for building lasting wealth.
And the best part is, these principles are accessible to anyone.
Yeah, I agree.
It's not about having a finance degree or being a Wall Street insider. It's about making those informed decisions, being patient, and sticking to your principles.
It's about having the right mindset and playing that long game. Okay, so
yes,
we've got a solid grasp on the core principles.
We do.
But there's one more intriguing aspect of Buffett's philosophy that we haven't touched on yet.
Oh.
The concept of Mr. Market.
Ah, yes, Mr. Market. Okay, so brilliant analogy can really help us understand how to navigate those emotional ups and downs of the stock market.
Okay, I'm intrigued. Tell me more about this Mr. Market.
So Buffett imagines the market as this manic depressive character named Mr. Market.
Okay.
Each day, Mr. Market shows up at your door, offering to buy or sell you stocks at a certain price.
So it's like having a business partner.
It's like having a business partner.
Who's a bit unpredictable.
Very unpredictable.
Some days he's super enthusiastic, optimistic.
Right, yes.
Other days he's just gloomy and pessimistic.
Right. Some days Mr. Market is euphoric.
Okay.
Convinced that the sky's the limit.
Yeah.
He'll offer you ridiculously high prices for your stocks.
So that sounds like a good time to sell, right?
It could be.
Yeah.
If the price is truly above what you believe the business is worth.
Right.
But then other days, Mr. Market is depressed. Convinced the world is ending.
Oh, no.
And he'll offer you just bargain basement prices for your stocks.
And that's when you might want to buy.
Exactly.
Assuming the underlying business is still sound.
Right.
It's like he's having a fire sale.
It is.
And you can snag some great deals.
Exactly. The key is to not let Mr. Market's emotions dictate your decisions. Recognize that his mood swings are temporary and often irrational. Instead, you got to use his mood swings to your advantage.
How do you do that?
Buy when he's fearful and sell when he's greedy.
So it's like having a neighbor who loves to haggle.
It is.
Sometimes he's trying to sell you stuff at inflated prices.
Right.
But then other times, he has a garage sale.
Yeah.
Where you can find hidden treasures.
Exactly.
For pennies on the dollar.
That's a great way to put it.
Yeah.
The point is, Mr. Market is there to serve you.
Yeah.
Not to guide you.
You're the one in control. You decide when to buy and sell.
Yes.
Based on your own analysis and assessment.
Based on your analysis.
Of that company's value.
That's right. Don't let Mr. Market's mood swings derail your long-term investment strategy.
Yeah.
Remember, he's not always rational.
Yeah.
But you can be.
So it's a powerful reminder.
It is.
That investing is as much about psychology as it is about finance.
It's both.
Yeah.
And that's another key element of Buffett's investment philosophy. Staying rational, staying focused, and making your own decisions.
So we've gone from the analytical side of investing.
Yes.
Analyzing those businesses, understanding financial statements, to the more psychological side.
The psychology of it all.
Managing those emotions.
Yes.
Resisting that market hype.
Right.
Staying true to your own principles.
That's the key.
Yeah.
That's the key.
I like that.
And as we delve deeper into Warren Buffett's world, it becomes clear that his success isn't just about picking the right stocks.
It's more than that.
It's about having the right mindset, the right temperament, the right approach to life and business.
Yeah. It's about aligning your investments.
It is.
With your values.
Your values.
Your goals.
Yeah.
Your vision for the future.
That's right.
Yeah.
And while we may not all achieve the same level of financial success as Warren Buffett, we can all learn from his wisdom and apply his principles to our own lives.
Absolutely. So as we continue on this deep dive journey, we're not just learning about investing.
No.
We're learning about life, about making smart decisions.
That's right.
And about building a future we can be proud of.
Well said. And remember, the journey is just as important as the destination.
I like that. Keep exploring.
Keep exploring.
Keep learning.
Keep learning.
And keep that Buffett-inspired wisdom flowing.
I love it.
All right, we're going to take a short break.
Okay.
And when we come back, we'll wrap up this deep dive.
Right.
With some final thoughts and key takeaways to help you put all this knowledge into action. Okay, so we're back. And I'm still thinking about that Mr. Market analogy.
Yeah, it's a good one.
It's a really good one. It's a great way to think about the market's behavior.
It really is.
But let's shift gears for a bit.
Okay.
As I was reading the Snowball, another thing that really stood out was Buffett's emphasis on the power of focus.
Focus,
He's so selective about where he puts his time and energy.
Well, yeah, it makes sense when you think about it.
It does. I mean, he's achieved so much.
Right.
It's not surprising.
And he's known for saying that the difference between successful people and really successful people is that really successful people say no to almost everything.
It's about
Prioritizing, eliminating distraction.
Honing in on what truly matters.
That's it.
Think about his famously sparse calendar. It's not an accident.
No, it's very deliberate.
Yeah, so it's not just about working hard. It's about working smart.
Exactly.
Choosing your battles.
Choosing your battles.
Directing your energy where it'll have the biggest impact.
That's right. So how does this laser-focused thinking show up in his investment strategy?
How does it show up in his investing?
Well, it's evident in how he constructs his portfolio.
Okay.
He doesn't try to be a jack-of-all-trades investor.
Right.
You know, dabbling in every sector or chasing the latest trends.
Right. He's not following the herd.
No, he's not. Instead, he concentrates on a relatively small number of companies that he knows and understands deeply.
So instead of spreading himself thin, he goes deep.
He goes deep.
Really getting to know those businesses that he invests in.
It makes you wonder, how does he decide which companies make the cut?
Well, remember his principle of staying within his circle of competence? That plays a big role. He avoids industries or companies that he finds too complex or difficult to understand. Instead, he focuses on businesses with straightforward models, strong track records, and a clear path to future growth.
It reminds me of that saying, it's better to be a master of one than a jack of all trades.
That's it.
So he's not just picking stocks, he's building this focused portfolio of companies he believes in for the long haul.
Exactly. And this focus allows him to really understand the nuances of those businesses, their competitive landscape, their long-term prospects.
It's about quality over quantity.
Absolutely.
But it's not just about the numbers, right?
Right.
Buffett also seems to place a lot of emphasis on the people running these companies.
The people, yes, absolutely.
He values strong management teams. With integrity, vision, and a track record of success. He's often said that he invests in people as much as he invests in companies.
So it's about finding leaders who share his values, his long-term vision.
His vision.
And that commitment to ethical business practices.
That's it.
It seems like Buffett really understands that a company is only as good as the people running it.
Absolutely. And, you know, that focus on relationships extends to his own business partnerships. Most notably, his decades-long collaboration with Charlie Munger. His vice chairman at Berkshire Hathaway.
Oh, the dynamic duo.
I've
always been fascinated by their partnership.
Yeah, they complement each other so well.
They do.
You know, Munger brings this unique blend of wisdom, wit, and contrarian thinking.
I can see that.
He's known for his ability to cut through complexity, get to the heart of an issue.
Right.
Together they built one of the most successful investment firms in history.
That's amazing. It's a reminder.
That
we don't have to do it all alone.
No, we don't.
Finding the right partners, mentors, advisors can make all the difference.
Can make a huge difference.
And speaking of learning from others, we can't forget the value of continuously seeking knowledge. Expanding our understanding. Buffett's a voracious reader. He's always learning. And he believes that lifelong learning is essential for success.
Investing and in life.
I think that's a great note to end on.
I think so too.
We've covered so much ground in this deep dive.
So much.
From the analytical aspects of investing, like understanding those financial statements, identifying competitive advantages, to the more psychological aspects, like managing emotions, staying focused on your goals. It's been an incredible journey.
It has.
And what's really striking is how all these principles, from compounding to Mr. Market to the importance of integrity and partnerships, all fit together to create
a holistic approach.
A holistic approach to investing into life.
That's right. It's not just about making money.
Right.
It's about building a life
of purpose,
of meaning,
and
lasting value.
I love that.
And while we may not all become billionaires,
right,
like Warren Buffett, we can all strive
absolutely
to embody